Warren Buffett is one of the richest people in the world, and he built much of his fortune using a strategy called value investing. Imagine being able to identify investments that others overlook and turning them into long-term wealth. That's exactly what we're discussing today. Stick around to learn the core principles of value investing, avoid common mistakes, and discover how you can use this method to grow your wealth sustainably. Value investing is the art of buying stocks that are undervalued by the market. It's like finding a diamond in the rough or a $20 bill for $10. The goal is to identify companies trading below their intrinsic value. Intrinsic value is what a company is truly worth based on its fundamentals, not the market's mood swings. Think of a stock priced at $50, but based on its financials, it's worth $70. Value investors see that as an opportunity to buy low and eventually sell high. Now that we know what value investing is, let's dive deeper into the principles that make it work. These are the building blocks of becoming a successful value investor. The first principle is margin of safety, which means that you should always aim to buy at a significant discount to intrinsic value. This cushion protects you from market volatility or errors in your calculations. You might be wondering, how do we calculate intrinsic value? There are two main approaches. The first is the discounted cash flow, DCF, model, which estimates a company's present value by projecting its future cash flows. While this method is comprehensive, it can be complex for beginners. The second, more accessible approach uses valuation metrics like the price-to-earnings (P/E) ratio. Another common question is, what counts as a significant discount? Most value investors target 20% to 30% below their calculated intrinsic value. For example, if you calculate a stock's intrinsic value at $100, you might aim to buy at $70 to $80. This buffer protects against calculation errors and market volatility. More stable companies might warrant a smaller margin, while riskier investments need a larger safety cushion. The second principle of the value investing strategy is long-term perspective. You should know that value investing is not about quick wins. It's about patience and holding on to investments until the market recognizes their true value. This is where many new investors struggle, but patience is the key to success. And the last principle is research-driven decisions. Successful value investors do their homework. They analyze financial statements, assess management quality, and understand the industry's landscape. Financial statements are typically available on a company's website. For example, NVIDIA are sharing all the information about their financial reports in their investors' website. You can also find some helpful information in the investing and the news platforms like Yahoo Finance or Google Finance. If you've made it this far and you're getting value from this video, drop a fire emoji in the comments. This lets me know you're following along and enjoying the content. I'll be happy to see and reply to your comments and questions. Understanding the principles of the value investing strategy is great, but how do you actually put them into practice? I will show you now how to identify value stocks in practice by following 3 steps. Step 1. Look for undervalued metrics. Key metrics like the price-to-earnings (P/E) ratio and price-to-book (P/B) ratio can signal undervaluation. For example, a P/B ratio lower than the industry average might indicate a bargain. Step 2. Analyze financial health. Check the company's balance sheet for low debt, strong cash flow, and consistent earnings growth. These are signs of a stable business. Step 3. Study the business model by understand what makes the company unique and whether it has a competitive advantage, like strong branding or patents. Companies with a moat often weather tough times better. When evaluating this, ask yourself, what is the company's unique value proposition? How does it stand out in its industry? This understanding can help you gauge its long-term potential. And the most important thing here is to detect the pitfalls to avoid so you don't make costly mistakes. The first one is chasing cheap stocks. Just because a stock is cheap doesn't mean it's a good value. Look at the fundamentals, not just the price. You should follow the 3 steps, not only the first one. The second mistake to avoid is ignoring red flags. You should be wary of companies with declining revenues, high debt, or management issues, no matter how cheap they seem. The third and last mistake is the lack of patience. Keep in mind that the market doesn't always recognize value immediately. Selling too soon can mean missing out on huge gains. So that's the foundation of value investing: identifying undervalued stocks, staying patient, and making research-driven decisions. In the next video, we'll explore growth investing and how it differs from value investing. You won't want to miss it. If you found this video constructive, give it a thumbs up and let me know in the comments if you have any questions or a topic you'd like me to cover in the future. Your feedback helps me create content that serves you better. And don't forget to subscribe for more valuable content. Thanks for watching, and I'll see you in the next video.